Hi, my name is John Palmer, Senior Vice President and Head of Real Estate Strategies for Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of November. But as always, I'll preface my REIT industry commentary and share a few observations about the macro environment. November was an interesting month as we received both positive and negative news. On the positive side, after 43 days, our politicians in DC were finally able to end the longest government shutdown on record and get the government back open. And while it doesn't appear that there was a lot accomplished from a policy perspective, it's certainly a positive to get paychecks flowing again through the approximate 1.4 million government workers. Next, following the Fed's October rate cut, recent commentary from several Fed governors suggests that they are prepared to do an additional rate cut at their next FOMC meeting, which happens next week. Further, it appears that President Donald Trump has coalesced around Kevin Hassett as the next Fed chair once current chair Jerome Powell's term expires in May. Mr. Hassett is more of a dove, which would be certainly positive for markets in general and real estate specifically. Now, on to the bad news. The jobs market remains very uncertain. Now, we didn't get an official October unemployment rate given the government shutdown, but ADP recently reported that the labor market slowdown intensified in the month of November, with private employers cutting 32,000 jobs, with small businesses hit the hardest. We will get a November unemployment report in a couple weeks, and most analysts expect that that number will go up from September's 4.4% level. Lastly, let's turn to inflation. The October inflation rate remains stuck at 3.0% year over year, which is flat compared to the September reading. However, consumer sentiment regarding the price of goods and services is extremely negative, especially with millions of American consumers likely facing significant increases in their healthcare premiums in the months ahead. Thus, elevated inflation remains an explosive political issue, and it may potentially handcuff the Fed from future rate cuts. With that macro commentary behind us, let's move on specifically to real estate. On the first slide, we show the 10-year Treasury chart through the end of November. As a reminder, the 10-year started the year at 4.57% and ended November at 4.02%. So the 10-year yield has actually come down 55 basis points during the year-to-date period. Switching to REITs, on the next chart, you'll see the year-to-date performance for the MSCI US REIT Index. After a fair amount of volatility in April, the index has generally rebounded and posted a positive 2.26% return for the month of November. For the year-to-date performance, the RMZ started the year a little over 1306 and ended November at 1331. So from a price perspective, it's up only about 2%, but when you factor in dividends, the RMZ registered a total positive return of 5.42% for the first 11 months of the year. Next, I thought it would be helpful to put the year-to-date REIT performance in context with the broader market. On the next chart, I have broken out the S&P 500 into its 11 GIC sectors. As you can see, year-to-date, the REITs in the S&P 500 have produced the second worst return by sector, and I think all market participants are hoping a reversion to the mean trade materializes in the coming year. On the next chart, we highlight the November REIT market performance by property sectors. November was generally a strong month for REITs, with 12 property sectors positive for the month and 5 sectors negative. Leading the pack were healthcare, lodging, resi mortgage REITs, regional malls, and apartments, while data centers, specialty REITs, and timber lagged for the month. On the next slide, we compare property sector returns for the first 11 months of 2025. On the left, you can see that healthcare has significantly outperformed year to date, but we have also seen strong performance from resi mortgage REITs, industrial, freestanding or net lease REITs, and regional malls, whereas timber, data centers, single-family rentals, and apartment REITs have generated strong underperformance year to date. Lastly, I thought it would be helpful to show the change in valuations over the year. As you can see on this last slide, implied cap rates for the most part have remained fairly steady over the past 11 months. However, the noticeable sectors would be data centers and specialty REITs, which have seen cap rates widen a fair amount, while healthcare and industrial REITs have seen meaningful cap rate compression. But the overall implied cap rate for the REIT market currently sits in the mid sixes, which still remains a little wide to long-term historical averages. As always, thank you for your time, and if you have any questions, please do not hesitate to reach out to Westwood directly. I look forward to sharing additional real estate updates with you in the future. Thanks.